Hey, good afternoon, folks. My name is Steve Resch. Let's get started on this presentation. Hope you can all hear me okay. And what I wanted to do is just today we're going to be talking about advanced retirement planning with home equity. And what does that mean? It just really means using home equity, in our case, access with a reverse mortgage to help safeguard and enhance the retirement plan. So, a little background about myself. I wear two hats. I am a financial advisor. I have been since 1987. I've had my own practice since 1994. It's a much smaller practice than it used to be. I've scaled down a lot because of the other hat that I do wear, where I'm Vice President of Retirement Solutions at Finance of America. And in that role, I do what I'm doing today. I help educate advisors and loan professionals on using home equity in retirement planning. And my day-to-day activities are really talking with advisors. A lot of the scenarios that we're going to talk about today are scenarios that we have worked with specific advisors about. So, with that said, who is Finance of America? We're actually one of the largest reverse mortgage lenders in the United States, have been for the last 20 years. We are also cornerstone partners of the FPA, Financial Planners Association, and in that relationship, we provide reverse mortgage education for their members as well. So many of which may be on this call today. What we want to accomplish today is really a broad-based understanding of the reverse mortgage program, and that's within the perspective of retirement planning versus the traditional utilization. And what I mean by that is that, a lot of times we think about reverse mortgages, it seems to have a history of being a loan of last resort. And I think that's one of the worst utilizations of home equity. I think when it comes to retirement planning, that makes much more sense to me. And so that's the perspective that we're bringing to the presentation today. Now, if you are a certified financial planner, there is one CE credit available for attending this session today. To access this, you have to get to the end, and on the last slide, I'm going to present a barcode that you can scan. And there is unfortunately an $8 charge to do this. As a lender, we are not allowed to give away credits. Even though I think if you're sitting with me for an hour, that you should be able to get it without, or you paid your dues. But in any event, there is an $8 charge. You can do that through the barcode and then register to get your CE credit. Again, this is for certified financial planners. This is worth one CE credit. That said, let's get rolling here. Feel free, by the way, to post anything you want in the chat box or the Q&A. A lot of times we have loan professionals on here who do a great job answering a lot of the questions that get posted. So feel free to post them. And at the end of the session, I will also make sure that there are no unanswered questions. Okay. All right. So enough with the intro. Let's get rolling. Retirement resources, three-legged stool or a chair. And what this means is a lot of financial advisors are very familiar with the three-legged stool. This has been around for decades. We've got our Social Security on one leg, pensions, which include your IRAs, 401ks on another leg, personal savings on the third leg. And, there's been a lot of talk about how that personal savings rates aren't what they used to be. But what is not mentioned really is that home equity isn't what it used to be either. Home equity used to be a very minor part of people's net worth. And now that's changed dramatically. In many cases, we have home equity that's equal to 50% or more of someone's net worth. It's really come into its own. And so what I like to think of now, a better analogy would be a chair rather than a stool. We've still got our three legs, but the home equity now is this backdrop here. And this is something that we can lean on. It's there to support us. Who wants to sit on a stool for 20 or 30 years? You've got home equity that you can, again, lean into, support. And this makes for a better retirement as far as I'm concerned. So uh, moving forward, here we go. Why is home equity not included in most financial plans? Really, it's been the greatest challenge to include home equity has been our inability to effectively access this. And what does this mean? In the past, in order to get to the home equity, you would oftentimes have to downsize, sell the home, relocate. There's been some insurance companies that have published studies about how you can add an extra $100,000 to your retirement by downsizing. Well, that can be okay, but a lot of times, this really doesn't consider the whole emotional part of downsizing, moving to a new location. People can be attached to their homes and they don't necessarily want to do that. So downsizing or selling to access the equity isn't always the best solution. The other option has been to do a traditional refinance, and that's okay too. It can give you a lot of money. However, you've got a monthly payment now that you have to add to your budget. So that's not really always the most effective way as well. So this is where the reverse mortgage now comes into play because we can have access to our equity. All proceeds from a reverse mortgage are income tax free because they're loan proceeds. So we have access to this equity, depending on the program or the product rather, up to $4 million. There are no required monthly principal or interest payments. And this is where the game changer comes into play. Because again, if you do a traditional refinance, now you've got to add monthly payment into your budget. This way, we have access to capital with no impact on the budget. Excuse me. What does this do? This gives us liquidity, options, and flexibility in our financial plan that we may not otherwise have. So with that said, let's look at some of the details about the product itself. We're going to take a look at eligibility, safeguards, proceeds, costs, and features. In particular, the FHA line of credit. So let's start on this. Minimum eligibility requirements. The borrower must be age 62 or older for the FHA products, 55 or older for the proprietary products. Now, you can have a non-borrowing spouse, that's someone who is not 62 or 55. But for the FHA product, the available proceeds are based on the age of that younger borrower. Now, you must live in the subject property as their primary residence. And vesting may involve either revocable, irrevocable trusts, as well as life estates, in addition to a normal fee simple vesting. So I only bring this up because a lot of times I hear people say, I like to talk to people about reverse mortgages early in their years, like in their 60s, and a lot of times we may get the pushback from the advisor. Well, we may want to put the house in a trust down the road. Well, you can certainly do that. It doesn't have to be determined when you do the reverse mortgage. You can change the vesting down the road, or it can be in a trust already, and that's fine too. So don't let the current or potential future vesting get in the way of considering a reverse mortgage earlier rather than later in your retirement years or your retirement planning years. Now, the proceeds are based on the age of the youngest borrower, current interest rates, or in case of the FHA, youngest non-borrowing spouse as well, current interest rates and the value of your property. So you can, with the FHA product, we have what's called a maximum lending limit. It's 1,209,750. And what that means is that is the highest value that FHA looks at to determine, number one, the loan amount, and number two, the insurance. So you can still do an FHA loan on, say, a $2 million property if you wanted, but FHA is only going to look at the first $1.2 million of value, again, to determine the loan amount. And that goes back to this first line here, what the proceeds are based on. Age of youngest borrower, current interest rates, and the value of your property. This is the maximum value that FHA considers. Again, you can do it on a higher value property. This is the most they will look at. Out of these proceeds, all existing liens must be paid off. The balance is available in cash, 10-year payments, which is like an annuity payment. It's a guaranteed payment that comes in every month for as long as your client is living in the home. Line of credit or any combination of these, and this of course depends on the products. Not all products have lines of credit available or 10-year payment options. So what I've put together here is just a little chart to give you an idea. I always get asked, well, how much can you get? And these are not exact numbers, but again, keep in mind the fact that it's interest rates, age, and value of the property that determines it. So if we're looking at a maximum home value here, or even a smaller home value. It doesn't really matter. For a 62-year-old, they're going to get about 35% of the value up to this maximum amount of home value. 72-year-old, about 41% of the home value, 82-year-old, about 51%. We can see that it increases every year, basically. Now, again, if you did an FHA on a $2 million property, it wouldn't be 35% of the $2 million. It would be 35% of the 1,209,750. Again, that's the maximum value that is considered for both mortgage insurance and principal limit or the loan amount. Now, the Home Safe is our proprietary product. These are available really for values up to $10 million. And these start at a younger age 55. And for here, we can see 55-year-old would get about 32%, 62-year-old 34%, 72-year-old 40%, 82-year-old about 50%. So again, these are higher valued properties, higher loan amounts, but the percentages start at an earlier age, 55 years old, in most states. It's not available in all states. Now, the cost to doing a reverse mortgage, we have your traditional closing costs. These would include anything that you would have on a normal mortgage, your appraisal, your settlement fee, title insurance, recording fees, etc. All of those things you're going to have on a reverse as well. When it comes to the reverse, though, we also have a counseling fee. Counseling is required whether you're doing proprietary or FHA products, and that fee is generally $200 or less, I would say, but it is a required fee that the client needs to pay on their own. The lender cannot pay for that. And also then with the FHA product, we have a mortgage insurance premium. And I'll discuss that really on the next slide, but the mortgage insurance premium, again, is on the FHA only. All of these fees, except for the counseling, can be financed as part of the loan. So the client doesn't have to really write a check for these things. Everything can be financed as part of the loan. Now, the mortgage insurance premium on the FHA, this again, FHA products only, HECM, home equity conversion mortgage. That's the FHA term for a reverse mortgage, home equity conversion mortgage. It amounts to 2% of the appraised value up to, here's that limit again, 1,209,750. This is what I talked about before. It's the maximum amount that the 2% will be assessed on. In addition, there's a 0.5% on any outstanding loan balance compounding monthly. So an example of a 2%, if we go to a home value of $500,000, we can see it's $10,000. If we have the lending limit of 1,209,750, we can see the maximum is 24,195. And as I said before, you can do the FHA even on a $2 million property if you want. The insurance will be capped at 24,195. Okay. Consumer and advisor safeguards. Mandatory counseling, I mentioned this. Everyone is required to attend a counseling session, and this is both a consumer and advisor safeguard. For you advisors who are on the call, one thing about the counseling session, they really talk to the client to make sure that the client understands the product, their options, and they're also checking to make sure that the client is cognitively able to understand these financial transactions that they're going into. We know that it's harder the older people get to understand financial transactions, but we want to make sure that the client does truly understand what they are doing. So if the counselor, if the client passes all of these things, attends a session, and the counselor feels they are mentally able to go through this transaction, they will sign off on a certificate. It's a counseling certificate. The lender can then move forward with doing the reverse mortgage, but you cannot close a reverse mortgage without having that signed counseling certificate. So this, again, protection for the consumer, but also for the advisor. If the advisor suggests that maybe this could be something that would be helpful to the client, well, you will also have you'll have a copy of this counseling certificate as well. So, if someone comes back to you 5-10 years down the road and says, my family didn't know what they were doing, well, yes, they did. Here we have an independent signed counseling statement saying that the FHA-approved counselor did talk to your parents and they did understand what they were doing. So again, it's protection for everyone here. Other protections, non-recourse loan. What does that mean? What this basically means is that the loan is secured by the property, not by the borrower. That's unlike traditional financing where the property is secured by the borrower as well as the loan is secured by the borrower as well as the property. The non-recourse means that should, for example, you end up in a situation where you owe more than the value of the property. We'll talk more about that as we go along too, because that shouldn't be the case. But if it is the case, and you end up owing more than the value of the property, the borrower or their heirs are not responsible for that difference. So the loan is secured by the property only. Borrower retains title to the subject property. Borrower, oh, compliance switches around. What's this phrase? Borrower retains title subject to the mortgage lien. Yes, what this means, why I put this in here in my original form was that we have a lot of people who think that when you do a reverse mortgage, you're signing the house over to the bank, and the bank gives you money while you're living there, and after you die, they keep the property. And that couldn't be further from the truth. You still retain title to the property just as you would with any other mortgage. All remaining equity belongs to the borrower or their heirs. These loans can be refinanced. So when we look at these three items here, this is really where the reverse mortgage is like any other mortgage. The main difference is that there's no required principal or interest payment. But other than that, it's like any other mortgage. Again, you have title to it, you have the equity, and you can refinance these loans if you're not, if you want to. You're not stuck with this, where some people feel, again, like you're turning the house over to the bank and you're stuck. You've made this decision and now you can't get out of it. Couldn't be further from the truth. In this way, it's very similar to a traditional mortgage. So let's talk a minute about the client profile. Where does this make a lot of sense? First of all, if you've got clients who are planning to stay in the home for the longer term, and this is in particular with the FHA mortgage, and that is by far the most popular, and we can see that because of the home values, we're up to $1.2 million. So what I want to do if if a reverse mortgage makes sense for that client, I want to know that they're going to be staying in that home for a long enough term because of that upfront mortgage insurance. It is an expensive loan to put in place. So we want to have time to theoretically amortize that cost over many years so that it doesn't make the true cost of borrowing ridiculously high. If you put a reverse mortgage in place, an FHA reverse mortgage in place, and move out in 5 years, your costs to put that in place are really high, and they're really going to make your total cost of funds very expensive. So we want to be able to stay in the home for a longer period of time, again, to amortize those costs, number one. Number two, the home will appreciate over time as well. And people seem to forget about that. Your home 10, 15, 20 years down the road is going to be worth more than it is today when you put this in place. Real estate tends to keep pace over the long term with inflation. So that increased value helps to offset any debt that you're accruing against the property as well. So again, client profile, staying in the home for a longer term really helps to make this a viable option. When they have retirement planning gaps, and what are gaps? Basically, these are areas in their financial plan that could cause risk to that plan. I like to focus a lot on long-term care planning. I've seen this with my own clients, with the advisors that I work with. We have clients who know they need long-term care protection, but insurance solutions are very expensive and they don't want to part with that money every year for an insurance solution. So that to me is a gap because we have to protect the invested assets of the client. And speaking of invested assets, we're looking at, I would say, anywhere from $500,000 to $2.5, $3 million. This is the ideal client demographic. They've got money, but we're looking at a 20 or 30-year retirement plan. We want to safeguard these funds and ensure they continue to grow. Retirement planning gaps can counter that. It can put an excessive drain on these invested assets. So if they're not prepared for long-term care, for example, and they've got expenses on that could take away from these invested assets, which we need to continue to grow and compound and provide ever increasing income. Another gap would be just not enough liquidity. And we've seen this more and more where the home becomes a larger portion of someone's net worth, and maybe it's 50% of their net worth, and the other 50% is tied up into 401ks or IRA plans. And they don't have that extra liquidity to offset any risk that they may have, such as poor sequence of returns or major expense like a new roof that they have to put on, and they don't have that extra liquidity. So that again is a retirement planning gap. So I like to use home equity to really fill these gaps to help ensure that these funds will continue to grow and compound over time. Um, where it doesn't work, if you've got clients who have irresponsible spending habits, or we've got a bad situation and you're just looking to put a Band-Aid on it to kick the situation down the road for another couple of years, that doesn't make sense. That's not really what home equity should be doing. It should be providing a sustainable solution, something to safeguard and enhance the retirement plan for the long term. So what are some of the opportunities that we can do with home equity? Manage long-term care risks. I talked about that. Eliminate a mortgage payment. What does this do? This helps, increase cash flow to the household, which can in turn help reduce asset distribution rates. This is one of the big things I've seen, I've listed these three here are the big top three that I talk with advisors about all the time, or they come to me about how do we manage long-term care risk? How do we get rid of a mortgage payment because the client just doesn't have enough cash flow and they're going to need to take more money out of their investments than they should? So these are all really kind of working together. The top three concerns that advisors have and their clients have. Other opportunities, alternative liquidity source, which I just mentioned, having extra backup funding to manage sequence of returns or anything else that could cause a disruption to their retirement income plan. And relocating. A lot of people don't understand you can use a reverse mortgage to relocate. And I mentioned before, a lot of times people don't want to have to relocate, but we also have people who choose to relocate. They want to be closer to family or want to be in a better community that's more supportive of their lifestyle. Relocating, using the reverse to do that can help get you into the home you want to be in without draining invested assets or taking out a monthly payment. And then there's other opportunities such as paying taxes on Roth conversions. I'll talk more about that later on, but other legacy planning things that we can do. But these are the main issues right here, or the main opportunities using home equity, these top four. Line of credit. I mentioned before we're going to talk about the FHA line of credit. I think this is one of the greatest retirement planning tools in the FHA suite of products and retirement planning option rather. And I did a little side-by-side comparison between a traditional HELOC and an FHA home equity conversion mortgage line of credit. And I've done this, a lot of times I've had people say to me, well, if we want to use home equity, we'll just do a HELOC. They don't cost anything to put in place and you've got the money available. And that's true. However, the problem that I have with HELOCs is, and for any of you who were in business in 2008 and 2009, I had a lot of clients with HELOCs on their homes. Everyone had a HELOC at that point in time. And the banks started freezing them or calling them because the real estate values had collapsed. And so I would get calls, hey, I got to sell stock. I got to pay off this HELOC. The bank wants their money now. We started seeing this again in 2020 after the S&P took a major hit over a 6-week period because of the COVID impact. Banks started shutting down their HELOCs once again. So from my perspective, if I'm bringing home equity into a retirement plan and I'm looking to safeguard and enhance that retirement plan and having it available for the next 20 years or so, I want to know that if there's a problem, that home equity is going to be available to me. And that's why I would always lean towards the FHA product as a long-term solution for having access to home equity for this reason alone. It can never be called or recast due to a change in the value of the property. That's the biggest. So your home value could drop to zero. The stock market could collapse and drop by 50, 60%, doesn't matter. Your line of credit, if you've put a line of credit in place, will continue to grow and compound and be available to you, even if that collateral that it's secured by the home is worth zero. So this to me is a great, great peace of mind, great safeguard. And It's eligible to the client again, no matter what happens to the other factors in the economy. And of course, there's no payment required. Unused amount, as I just mentioned, grows over time. We'll talk more about that in a moment. Because there's no risk of foreclosure if that monthly mortgage payment is not made because there is no monthly mortgage payment. So there's a lot of advantages to the FHA product. Again, the disadvantage is going to be more cost to put it in place, but it's not a fair weather product. You know, it's going to be there regardless of what's happening in the economy, unlike the traditional HELOC. So what can we do with this line of credit? I talked about managing long-term care risk. Again, that's being one of the main utilizations I've had for home equity in my practice and with a lot of the advisors I talk to. You can do a lot of things with it. Let's say you have insurance solutions that really make sense. The client has an insurance solution, or this is what they're looking for. You can use that extra liquidity from the home to pay for these strategies. Now, I will say you can't apply for an insurance product, and when they ask how you're funding it, you can't put down that you're doing a reverse mortgage or any type of mortgage. That's considered premium financing, and the product will be denied. Uh, but say you have existing insurance products in place that make sense, and you get into retirement, now it's creating cash flow issues for the household. Supplement the household cash flow with home equity to continue with these products if these make sense and these are what you want to do. Excuse me. Then you can also, this is where I like to use it the most, self-fund protection. The unused portion of your line of credit will grow and compound based on current interest rates. So that line of credit can be actually your source to draw from down the road when you need assistance paying for long-term care expenses. So let me give you an example. We've got Claire here. She's got a home worth 750. She has no loan balance. She wants to age in place. And this is a biggie. I don't know about the other advisors on this call, but all of my clients and everyone I talked to said, whatever you do, make sure I never have to go into an institution. I think, especially after what happened during COVID, people want to stay in their home. So we need to be able to make the home accessible, and we need to be able to pay for in-home care. And this is where home equity again can come into play. So Claire wants to stay in her home. She's looked at traditional long-term care insurance solutions, but they are expensive. She wants to retire sometime in the next few years. So cash flow is important to her, as well as managing this risk. So if we look at the FHA product, based on her age at 62 and the interest rates, current interest rates, and the home value, she's eligible for about $267,750. Excuse me. Now we're going to subtract from that about $24,000 for closing costs. What's left over is 243,342. If we leave that in a line of credit, as I mentioned a few times, this is going to grow and compound at whatever the current note rate is. Now, right here, we're starting at a 6.25%. That's initial mortgage rate of 5. So we're starting at an initial rate of 6.25%. The FHA line of credit grows and compounds at whatever the current rate is. This is an adjustable rate loan. It has a 5-point lifetime cap. So this could go up 5 points, it could go down 5 points, which is to me, it's a very nice feature because it's tied, interest rates go up and down based on inflation. So it's almost like a built-in inflation protection. If rates are higher, that means inflation's higher. Your line of credit is going to grow at a faster rate. In the meanwhile, let's look at this graph here. This is based on the current rate of 6.25%. So let's say it stayed at 6.25%. 20 years down the road, Claire's in her early 80s now. Maybe she's got some long-term care expenses that are coming down the line. We can see that her line of credit, which started out at 243,000, is now worth 846,000 because it's grown and compounded at the current note rate. Doesn't matter what's happened to the value of the property. But I wanted to show here too, this home, we have a 4% appreciation rate, which is the rate that FHA suggests that we use in illustrations. We can see that the home has appreciated to $1.6 million as well. So again, this is what I was trying to bring out in the beginning. We may incur a cost to put one of these in place, but down the road, even though that cost is going to grow in relation to the value of the property, it's really minimum considering the value that we are getting out of this, which is access to about $850,000 of home equity anytime we want or for whatever purpose. Now, I mentioned as well, too, that these are adjustable rates. It can grow and compound at whatever the current note rate is. So let's give you another example here. Let's say that the home is flattened out. Let's say year two, it stopped appreciating for whatever reason. For illustration purposes, it stopped appreciating as of year two. Interest rates went through the roof as well. So now we are accruing at 11.25% rather than the 6.25%. So we can see 20 years down the road, the loan balance is much higher, 218,000, because the loan balance is growing at this rate, but so too is the line of credit. We can see the line of credit is over $2 million. And if we look at the graph here, got the line of credit at $2 million, and yet the home value is only 780,000. And as I said, this is a protection that comes into play with this FHA product. So the client theoretically could say, I want my $2 million, and we have to send it to them. We can't say, well, your home has dropped in value or we need another appraisal. No, we have to give them the $2 million. The client can put it in the bank and walk away from the house. They can put it in the bank and stay in the house. It doesn't matter. There's never payment required as long as they are living in that property. And when they do leave the property in a situation like this, they'll just sign it over to the servicer and walk away. Now, again, I'm not saying that this is the situation that will happen. HUD is the insurer on these FHA loans, and they want to make sure, or they want the client to have a retained equity position. This is the illustration that HUD would like everyone to have. So you still have a retained equity position throughout the life of the loan. And again, this is why they adjust these loan amounts based on the age of the client. The younger you are, the less money you get, as we demonstrated earlier, and the interest rates, because the higher the interest rates, the more debt will accrue against the property. Lower interest rates, so we lend less. Lower interest rates, less accrual against the property, so we can lend more. So these are all factors that come into play so that HUD is not in a situation like this. However, they are collecting a mortgage insurance premium, which you are paying 2% upfront of the value of the property, and you are also paying 0.5% that is accruing on any loan balance. So this is where the funds are coming into play for HUD to be able to make good on their obligations here. So this, again, is not a situation that we would anticipate, but that's what insurance is for. Insurance is there to protect against the unexpected or whatever. So just know that this is really a great way. It's a great peace of mind. I'll be perfectly honest with you. I have one of these on my home. I did a line of credit on my home. And there was also, I don't know if it's still available or not, there was a 10-point option, which I took because I want that 10-point opportunity. Should interest rates go through the roof, my line of credit will grow and compound at 10%. Even as it over the past few years, it's grown and compounded 7 and 8%. It's been absolutely great. But it's peace of mind knowing for me that no matter what happens around me, I can draw on this equity anytime I want, and it will be available to me. So it's a nice, again, nice peace of mind, nice feature to add to a retirement plan. Now, going back to Claire, what she had initially looked at was a $300,000 life insurance policy that had a long-term care rider. This was going to cost her $7,000 per year. 20 years down the road, she would still only have $300,000 available, but she would have spent $142,000 to have this protection in place. With the reverse, we put the line of credit in place. She's got $242,000 available from year one. This was her initial cost. Now, 20 years down the road, she's got, this number's not right. I have to update that number. It's 800-some thousand. Yeah, we're 846. I'm sorry, I didn't update these numbers. I updated the numbers based on current interest rates and forgot to change this page. But in any event, 840-some thousand is what she's got available at this point in time. A lot more than what she would have with the insurance, but the main point is that she has saved $142,000 in cash flow over the past 20 years and yet still managed her risk by having that access to the equity should she need it. Now, other uses for the line of credit, I mentioned earlier, backup funding source for managing sequence of returns risk or anything else. I've had clients where they moved into a new home, fairly new home, couple years old. Roof wasn't put on correctly. They got a $35,000 roof repair job. They didn't have the extra $35,000 floating around. Everything was tied up in their home or in their 401k plans. So we see this a lot of times, as I mentioned earlier. Money is tied up, and we need that liquidity for unexpected expenses. Backup funding source, managing sequence of returns risk. If your investments are underperforming, you're relying on those investments for income. Draw from the home and let your investments go through the cycle that they need to go through and recover. And then you can resume taking money out of your investments. So it's just managing a lot of risk, having liquidity. There's also debt consolidation. I hate borrowing to consolidate debt unless you are really determined that that's going to be a long-term solution for you. I don't understand. I've seen this many times too. People have $1 million, $1.5 million in IRAs and retirement plans, and they got 70, $80,000 in credit card debt. I don't really understand how that all works, but um, if you consolidate that debt and get it into a lower interest rate, and I would highly suggest paying down that reverse mortgage balance, but at least you're consolidating the debt and you've got some flexibility in your payment options. Eliminating a mortgage payment. This is an example. This was a couple, and this can work for any type of situation, but what they wanted to do was buy a second home, and they only wanted one mortgage payment. So they currently have a $2 million property with a $400,000 existing balance. They were looking to buy a second home. The second home is, I think, in the $600,000 range, if I remember correctly. Only wanted one mortgage payment. So we looked at the proprietary products, the Home Safe. They were eligible for $804,000. If we paid off the existing mortgage of $400,000, they've got $14,000 in closing costs. They've got $389,000 available. So again, I think the home they were purchasing was about $600,000. So they would need maybe a couple $100,000 mortgage. That would be one payment. And they were able to do this because they got rid of the larger mortgage balance on their principal property. Now, the other thing they could have done is put in place a Home Safe, what's called a Home Safe Second. This is a great product for anyone who has lower interest rate mortgages. And I think we had talked to them about this in this case because their current mortgage rate was 4.25%, which is an attractive rate. We ended up not doing it because it didn't give them all the money that they needed or the flexibility that they needed. But this could have worked in that you would retain that first lien position. This is great for anyone who has a low interest rate first lien position. They want to keep that low interest rate mortgage, but they're still looking for some extra cash. So they could have had $400,000 after closing costs would be 386, 652. They didn't do it because they would have still had a second mortgage payment then, because this wouldn't be enough to pay cash outright for this new home that they wanted to buy. But in any event, something to keep in mind for other situations as well. It's really the only reverse that can be in a second lien position. So it's something to consider again if you've got low interest rate mortgage and you don't want to give that up. This is another situation of eliminating the mortgage payment and managing the asset distribution rate. I talked about this earlier, where we eliminate that mortgage payment so the client doesn't have to take as much money out of their investments. This was a couple. They retired at 66, home value of $1 million. They had an existing lien of $260 for $1,784 per month at 7.31%. Now, they they got this because these were clients of mine. And they called up and said, "Great news, we're going to retire." And I said, "Okay, well, we've got to work on some budget items here, And they said, "Well, we've already refinanced the house. We paid off all our credit card debt." This was one of those couples that I mentioned that I don't understand why they have so much credit card debt. But in any event, this was one of those couples. We've paid off all our credit card debt. We've refinanced the existing mortgage, so we're down to payments of only $1,784 per month. I said, "Well, that's great, but let's look at what your total budget is." They've got an investment portfolio of $1.5 million. Based on their needs, including a $1,784 per month mortgage payment, they would have to take 6% per year out of their investment portfolio. Now, for advisors who are on this call, I don't know about you all, but I think this is a high distribution rate for a young couple to start out with. 6% of this. I know there's Pros and cons to the 4% distribution rate. I'm a 4%er myself because I think it's a nice tangible number that my clients can grasp onto when I say, if we take the 4% per year out of your investments, you should not run out of money down the road. And it's again, it's a number they can buy into. 6% is a hard number for me to sell. So my concern was high distribution rate, no liquidity because everything is tied up here in investments and the home. So we looked at doing a reverse mortgage, and based again on their age, value of the property, and interest rates, they'd be eligible for $386,000. We could pay off the existing mortgage balance of $260,000. Closing costs are almost $31,000. We've got $95,000 left over that can be in a line of credit and grow and compound over time. So this I really like because, again, got rid of the mortgage payment, so we can now drop the asset distribution rate down to 4% from 6%. And now we've got extra funds available to help manage unexpected expenses or poor sequence of returns risk, which we did not have before. So how does this look for them down the road, too? I like to look, if I'm suggesting someone put debt against their estate, I want to know that it's really going to enhance them. I hate to see debt drain away. It has to be in a position where it can, again, safeguard and enhance the legacy value. So let's look at this. I did a side-by-side comparison. Let's say they stayed at the 6% distribution rate. They did not put a reverse in place. They borrowed or they withdrew 6% of their investments every year, and we increased that by 2% per year for an inflation factor. But what we have here, 25 years down the road at age 90, they've only got $114,000 left in liquidity. The home is worth about $2.779 million. They're going to need to do a reverse mortgage at that point or sell the house or something else. What I will say here is that, I've done reverse mortgages. I've worked on cases with reverse mortgages. I'm not a licensed loan officer, but I've worked on cases of reverse mortgages where the clients are in their 90s, later 80s. It's a hard process for them. Again, it's a lot of financial transactions, a lot of paperwork to sign. There's appraisals, there's closings. It's stressful. It's very stressful at that point in time. Whereas if they'd put this reverse in place, now we can drop the distribution rate to 4% because we've eliminated that $1,784 per month mortgage payment. So we can drop the distribution rate to 4%. Now, when we get 25 years down the road, they have $2.2 million in liquidity. They're never going to run out of money. They've got plenty of money available to them. Their home equity is less, $1.2 million. But look at even the net worth, $3.5 million is their legacy value here versus 2.7 on this side. And that's simply because their investments, what I use for a long-term growth rate is 6%. I've always used 6%. It has turned out to be a very conservative rate. I've been using that, as I said, since 1994. It's been a very conservative rate, but I like to be on the conservative side. And using that 6% long-term growth rate, that's going to exceed what the home is going to appreciate over the long term as well. So this is why you've got to end up with a higher net worth if more of your assets are retained in investments rather than in real estate. So in any event, this was a great solution for them. We've provided liquidity throughout their retirement. We've safeguarded their assets so that they continue to grow and compound, and we've got protection in terms of a line of credit available. Now, another situation here too is, excuse me, when we're looking at income, required income. This was a case here where we've got this one couple, Greg, he retired, he was age 70, I'm sorry. He retired as a widower. And because he never thought he was going to marry again, he took the largest pension option available to him. He later married Tammy, who's 8 years younger than he is. So his concern was if he predeceases her, her household income is really going to be dramatically reduced because of the loss of his pension. So we looked at what's called a 10-year payment option. I mentioned this in the very beginning. This is almost like an annuity payment. It's a guaranteed payment that will come in every month for as long as the client is continuing to live in that home. Unlike an annuity, though, there is flexibility to this as well. I'll talk about that in just a moment. But let's look at what what they're eligible for. So based on their ages, we're going to look at the age of the youngest borrower. She's going to be 62, and the home value. They're eligible for 246,000. Closing costs will be 25,261. What's left over is 237,989. Now, they could convert this into a 10-year payment and from day one and take out $1,428 per month for the rest of whoever is living that home till the end. Or they could wait, let's say age 72. Let's say age 72. Now, Tammy is now a widow herself, and she's going to start taking out $3,000 per month. Age 82, almost $7,000 per month. Though what's nice about the 10-year option, and again, it's not at these ages per se, at any of these ages, you could take it out. This is an example of the calculations at these various ages. But what's nice about this versus an annuity, with an annuity, once you put one in place, the money's gone. You basically turn it over to the insurance company, it's gone, and you've got your payment set for the rest of your life, and that's it. With the 10-year option, you can change that. So let's say at age 72, she starts collecting almost $3,000 per month. Age 73 or 74, she says, you know what, I don't need this much money. I really only need $2,500 per month. Well, we can change that. It's like a $20 servicing fee to just redo the paper, but we can change it. So you can decrease the amount. You can stop the payment if you want, and it'll all go back into the line of credit. Or you can do what's also known as a modified term. And that's where you can say, I want X number of dollars for a certain number of years. How many years can I get for X number of dollars? So let's say at age 72, she says, I need $5,000 per month for the next couple of years. We can calculate that and see if that would work out for her. So in any event, what's nice though with a 10-year option, it's a guaranteed payment that comes in every month and you don't have to think about it. Other options that we mentioned, I talked about this in the very beginning, was the reverse for purchase. And 1 second. Yep. Okay. The reverse for purchase. What this is this where, again, you can use a reverse mortgage to purchase a home. And this really comes in handy when we're dealing with a lot of gray divorce situations. Couple ways to use a reverse with a gray divorce. We've had cases where one person wants to retain the family home, and so they may do a reverse to help buy out the separating spouse. But more often than not, they sell the primary home, split the proceeds, and then both separating parties have used the proceeds to purchase a new home for themselves. A lot of times it's condo or something like that, where we've seen they're able to get into another home without having to draw down their invested assets or to take on a monthly mortgage payment. So this can work out very, very well, again, for this whole great divorce situation. The main thing is we want to, again, retain those invested assets because as we've seen over the long term, they're going to perform better than your home will. So this is a way to get to where they need to be. This also works well for relocating. We've had a lot of people who, let's say they go down south for a while when they retire, and then they get older, need to be near family. They want to move up north again. It's a great way to relocate back to where you need to be, and again, without having to take on a monthly mortgage payment. Um, End of the loan. What happens here at the end of the loan? Uh, when the last borrower dies or really permanently moves out of that home or fails to comply with the loan terms. And what these loan terms are really is that you have to maintain the property. These are no different than any other mortgage. You have to pay your taxes, insurance, and maintain the property. So those are the loan terms. So if you don't do that, excuse me, I'm sorry. If you don't do that, or if you permanently move out of the home, or what does permanently move out of the home mean? You can go into an institution, let's say you've been in an accident or had surgery or whatever, and you go into a nursing home, and you can be there recovering. If that's a rehab center for you, there's no concern about it. The only time the concern comes into play is if you are there longer than 1 year. So it's basically if you're in an institution for more than a year, it's considered permanently moving out of the home, and then this comes into play. It's time to satisfy the loan. The other situation would be is it doesn't even have to be a year. Let's say the last borrower has had a stroke or they're in an institution and the doctors say this person will never come home again. Well, they are considered permanently out of the home. So even if it's only been a few weeks, if they are permanently out, then this triggers the end of loan responsibilities. So with that meaning, you have to notify the servicer that you're going to now work on satisfying the loan. You've got 6 months to satisfy this and up to two more 90-day approvals for extensions rather. And this would be, if you are in process of refinancing or selling it and you need more time, you could easily get that, provided you are actively working to satisfy that loan. Just as a reminder, though, taxes and insurance will continue to be due. Interest will continue to accrue. So it's nothing that you want to delay on. If that last borrower has died or moved out of the home, you want to start the process of satisfying that loan. And then regarding taxes, there is going to be a 1098 issued whenever interest payments are made. So the deductibility, though, is the same with any other mortgage. The proceeds need to be used to buy, build, or substantially improve that property for the deductibility portion. So just know you'll get a 1098. Whether you can actually deduct it is between you and your accountant, but the 1098 will come whenever interest payments are made. Another thing, too, I didn't mention this earlier, but if you make payments on a line of credit, you have a line of credit, and you make payments to reduce that loan balance, every dollar that you pay in to reduce that loan balance is going to be available in your line of credit as well. So this is only going to be on the adjustable product. So if you have a fixed rate product and you make a payment, it's not going to be in a line of credit. But if you have adjustable rate products and you make payments, that will be available in that line of credit for you to draw at a future date if you wanted to, and it will grow and compound at whatever the current note rate is. So your 1098 will show, the portion of that payment that went to interest, mortgage insurance premium, and principal. However, that's regardless of the fact that every dollar that you've paid automatically flows to that line of credit and is available for future use. So there's two different things there. Well, there's no impact on capital gains. Stepped up basis rules still apply. Community property states and trust, common law states, all those rules still apply. They don't change because it's a reverse mortgage. Again, this is to where people think that this is some weird voodoo type of thing that you're doing to the house. There's no difference. This is where it's very similar to any other mortgage. It's not impacting your capital gains. Your tax statements are still the same, etc. But bottom line, talk to a tax professional. We're not here to give tax advice. To wrap this up, when you're working with your clients, be open to situations where risk or desires are not effectively managed. We talked a lot about risk, and that being your long-term care, sequence of returns, things like that. Desires can just be simple things like, for example, you want to help your grandchildren pay for their college education. We've had multiple clients who are doing that. And they could not be able to do that unless they did a reverse. They couldn't spend on their invested assets. That would impact their future life. But they can spend on the home equity if they don't need it. So risk or desires, if they're not effectively managed, look at the facts about home equity as an option to offer, really the best of all scenarios to your clients. So that's what I had to share today. Here's that QR code I mentioned. If you are a certified financial planner, feel free to go ahead and scan this and request your CE credit. And let me see if we got any questions here or chats I need to answer. Ben, can you start with line of credit, then convert it to income down the road? Yes, I think you probably asked this before I answer that question. Yes, again, we can convert that to income down the road. That would be the 10-year payment option, and you can convert that back as well. Again, you can do a partial thing. So let's say the client has $2,500 coming in on a 10-year payment. You say, I only want 1,500. Well, we can convert that to the 1,500, and then that available funds, what's that not being used to make that monthly payment, will automatically go into a line of credit as well. So. Let's see, any other questions? A counselor told my borrower recently that counseling sessions are waived in California. I have never heard of that. Um, you may want to check with your account executive on that. I've never heard that at all. I will make some inquiries about that as well. Thank you for letting us know that, Juliet. Yes, you will get a copy of this webinar. I'm sorry I didn't mention that before. Everyone who's registered will get a copy of the webinar. It will come out later this afternoon or whenever it gets published by Zoom. Okay, is that it then? Looks like that's about all I've got here. Oh, you're welcome. Thank you. Um, okay, I'll leave this up for just another minute or so. If I've got any more CFPs who want to scan this, and if you have any other questions, feel free to post them. Now I'll keep on, I'll keep this for another minute or so. So reverse can be used for paying for assisted living, but then the person can be admitted and need to satisfy the loan. Curious how that would be structured. I'm not really following what you're saying here, Benjamin. The reverse can be used for paying for assisted living. Are you saying that both, if there are two people, would they both be moving into assisted living? Because then they're not really in that home permanently anymore. So that would have to, I don't really know how you would be using the reverse to pay for assisted living. Um, you've moved out of the home at that point. If you want to clarify that, I'll hang on for a minute too. But any other questions? Oh, thank you, Mike. Appreciate that. I don't know why for some reason my chat doesn't show up. I have to click on it to see it, where normally I used to be able to see someone has left a chat. So in any event, sorry, I'm a little slow on some of these. Okay, thank you, Gary. All right, folks, I'm going to shut this down now. I'm sorry I forgot to mention at the beginning, you will get a copy of the webinar. I will send it out later this afternoon. So thank you all for joining me today. I really appreciate it. I do this class every month. Also, if you ever want a refresher, just feel free to check the schedule. There's also for loan officers who are on this call, there is a marketing flyer in the marketing tab under the advisor section that has the dates for this and the next two sessions with links that you can share with your financial advisor referral partners as well. So that's it. I'm going to sign off. Thank you again for joining me today. Have a great rest of your day and week. Bye now.